Good morning and welcome to the first quarterly investor briefing. Our apologies for getting started a few minutes late here this morning. Just wanted to make sure that everyone was with us since we've got a big group this morning. So again, welcome. My name is Joseph Brooks. I serve as the Senior Director for Donor Services at the Greater Milwaukee Foundation. And on behalf of all of my GMF colleagues, we want to welcome you again and thank you for joining us this morning. Before we get started, I want to acknowledge the crisis this morning unfolding in Ukraine. Many of us woke up this morning to hear more about this tragedy unfolding on the news. The loss of human life, the loss of personal freedom. And I know that many of us are thinking about this this morning and certainly into the future as this crisis unfolds. It's something that has come up in the questions that we've received. All of you have sent in advance that we will get to later in the presentation. So it's my pleasure to get us started by introducing my colleague, Kristen Meckhamson, our Vice President for Development and Philanthropic Services, who will share a bit about our work in 2021, how that has set us up here in 2022, and pass the microphone to Mike Miller, who will carry the presentation. So Kristen, please take it away.
Thank you, Joseph. Good morning and welcome to our first investor briefing for 2022. Thank you for joining us today. It's always a pleasure to reconnect with our closest partners and those who walk shoulder to shoulder with us as champions for philanthropy. We are grateful for your trust in us and for the opportunity to brief you on our investment strategy in the current market. Before I introduce Mike Miller, I'd like to review our 2021 foundation results and impact, which was a year of tremendous growth and transformation. So here are our preliminary results for 2021. The foundation received cash contributions totaling $58 million. We are thankful for our generous philanthropic partners who contributed to start and grow their funds and to support strategic initiatives. We offer special thanks and welcome to donors who chose to work with us to open 78 new funds, including donor-advised funds, nonprofit endowments, field of interest funds, as well as designated funds. Many folks chose to establish legacy gifts, and those collectively totaled over $53 million, bringing our grand total to $111 million for the year. We also had a very productive grant-making year, awarding over $65 million, including $53.8 million in donor-directed grants, as well as $11.3 million in board-directed grants. While it's my privilege to share these results with you, it takes all of us to make this happen. Our partnership is about the lives touched and those we partner with in creating opportunities for meaningful giving and meaningful grants. We're very grateful to our philanthropic partners, community leaders, and all those who collaborate with us. We are truly greater together. And for us at the foundation, it's not just about what we're giving and investing in our community, it's about how we're going about this philanthropy. We are lifting lived experience as a critical aspect of our work, recentering community, particularly through our Thrive On collaboration with the Medical College and Royal Capital, to ensure that our future neighbors in Harambe, Halyard Park, and Brewers Hill share in decisions made about what will happen in and around our new building on Martin Luther King Drive. We are honoring donor passions, as we have done for so many years. Our philanthropic advisors worked alongside donors in grants ranging from $250 to 8 figures in support of so many incredible nonprofit organizations. We are especially proud to have partnered with an anonymous donor who made a commitment of $10 million to America's Black Holocaust Museum to support its reemergence, expansion, and long-term sustainability. I hope you're all planning to celebrate the museum's reopening tomorrow, honoring Dr. Cameron's legacy. We're also inviting donors to co-invest with us in priorities that align with your interests and our community's greatest needs and opportunities, as we endeavor to remake systems to give everyone access and opportunity when it comes to life building blocks, including early childhood education, health, housing, and economic stability. And we are reimagining philanthropy by using innovative tools like impact investing. and recognizing gifts of service and treasure, since we are all beneficiaries of philanthropy and every one of us has a role to play in building a Milwaukee for all. Looking forward to 2022, our goals to leverage philanthropy to transform our community are both ambitious and attainable. We have an exciting year ahead. On March 4th, the foundation will be making a major announcement about a historic initiative we've been working on, and I will not ruin the surprise, but I will ask that you keep an eye on your inbox so you can celebrate alongside of us and consider ways you may join us. As always, I invite you to stay connected through our e-newsletters and social media, and to reach out to your contact at the foundation as you consider ways to deepen your partnership. Now I'm happy to welcome Mike Miller to the conversation for our first quarter market update and report on investment strategies. Take it away, Mike.
Thank you, Kristen, and thank you, Joseph. It's really nice to be with you here today. And this, as Joseph pointed out, very difficult day for many people. And so our hearts go out to everyone involved with this conflict, and it's just a terrible day. To try to use what's happening now to help us see the perspective that we take that the Milwaukee Foundation's assets. I think it's extremely important that we're able to put these things in perspective as we consider the variety of different investment strategies that are used in the pool and the results that those are that we seek to generate over time. So we can go to the next slide. Perfect. So here you can see the returns of the pool, which I will update you through what's happening now, of course. But through the end of the year, the pool had an absolutely fantastic year, gaining almost 16% for the year, towering above its benchmarks. And a lot of that came from some very long-standing private equity commitments that we've made that have become more and more profitable, both in terms of the valuations and some of the cash coming back to the foundation. So that's a perfect example of long-term thinking on the part of the investment committee of the Greater Milwaukee Foundation, and the payoffs that, frankly, we don't know when they're going to arrive, but we're confident that they're embedded in the portfolio at different levels. What you can also see on this chart, so let me explain what the numbers are. The blue bars are the Greater Milwaukee Foundation's investment returns. The gray bar next to it is our primary objective. So as we enter into times like this with a lot of complexity in the world, a lot of complexity in the markets, it's important for us to keep in mind what we're trying to do, which is to sustain philanthropy and actually enhance philanthropy in the Greater Milwaukee region. Listening to all the wonderful work that Kristen spoke of earlier, and all the many, many other things that the foundation, all of you are involved with, this is what gets us up in the morning, is how do we achieve this goal of basically being above the gray bar. The red and the green bars are reflections of two other things to consider, which is what were the alternatives to the portfolio we built. At the end of the day, the foundation invests its money through a variety of passive funds and actively managed funds, and all of these funds come together in different ways to create diversification and higher returns. And so you have to be able to generate higher returns. And in an era, as many know, where index funds have ruled the day, we're extremely proud of the premium returns. You can see they've been earned over time. I want to just also draw your attention to two other parts of this. If you look at the 10-year column over there to the right, you'll see, same story with the Greater Milwaukee Foundation portfolio actually achieving a more than a 10% annualized return. The CPI plus 5%, which is our CPI plus spending, which is our basic benchmark, is up around 7%. The red and green bars were also above the CPI plus spending. So this was in theory, a do no wrong kind of climate. And what you have, though, is the Greater Milwaukee Foundation, of course, doing quite a bit right on top of that. So getting even more value than the indexes would have. So we're very excited about that. But take a look now, 2 more points to the left. And one of the things you might, if you didn't notice, I'm sure you know it day to day, is the gray bar is suddenly quite a bit higher than it's been in quite a while. And that is because it's inflation. And inflation has returned, as we all know. It's a really significant investment issue. It's fundamental to both the foundation's goals and how capital markets function. And so this is something we're going to spend some time on today, which leads me to one last point on this chart. Look to the far right-hand side of the screen where you see the 20-year columns. Great story again, but even more important in the sense that the premiums. So if you look at the gray bar compared to the red and green, you'll see that the gray bar essentially is at or above those two other bars. So what that tells you is that the benchmarks did not preserve purchasing power over the last 20 years, whereas the foundation portfolio did. And I think this is the era we're re-entering now, where it will not be so easy to achieve the primary goal of the benchmark. We're going to need those spreads that you see here, and we intend to earn them. And frankly, we do not take pleasure in the difficult things happening out there by any means, but we also there is a silver lining, I suppose, not to the Russia-Ukraine issue, but all the other issues out there, which is that this creates a lot of opportunities for very patient investors like the foundation. So if you turn to the next slide, this slide takes you, tries to put some perspective on what's happening in terms of long-term returns. So these are the exact same returns you just saw a minute ago, but the difference is that we've made them cumulative. So the other numbers on the prior page were per year. These are just, they're not really, you can't add them out, but you compound them essentially. And this tells an even more interesting picture. So the first thing it tells you is how insignificant any one year is. Those bars was a great year. It looked really wonderful on the prior page. But the reality is that we're really here for those bars to the right. That's what matters to us. That's what we care about. And so when you look at those bars to the right, what you see is pretty amazing compounding going on. And the spreads that look so small on the earlier pages now look quite a bit larger, and particularly those far right-hand bars I mentioned earlier. That's a towering advantage over our primary objective against CPI plus spending, and the other two bars not there. And that's extremely important as we go forward. And it also leads to another thing, which I know those of you who've been on these, hopefully they used to be in-person meetings, but webinars and in-person meetings in the past will know that we have had bad years, and we will have bad years again. And we don't like them, and I know you don't like them, but the fact is that when they do occur, they occur because we're planting seeds for the future, and we think we're going to the place where the puck will eventually get to use an old hockey analogy. And so sometimes you have to be a little embarrassed in the short run, and people don't like that, and we don't like it. But the reality is it's the secret sauce to getting these long-term outcomes you saw earlier. So you have to be willing to take the pain. So let me give you a quick update because I did mention I would. So you saw those towering returns. So let me tell you where we're at with the pools through last night. I don't have today. We don't have a real-time pricing system. We have an overnight pricing system. But the portfolio, just to give you some perspective, is actually behaving very much like we would have hoped it would, which is it's losing a lot less than the indexes. It's a very long-term oriented portfolio, so it is losing money this year, just to be clear so far. But here are the numbers through last night. The portfolio was down 6.6% through yesterday. Its benchmark is down just over 7%. And to put that in perspective, the S&P 500 is down 11.2%. So outperformed, plus captured roughly 60% of the downside for the S&P. And I want to just put that in contrast to what happened back in the 2020 era around COVID. The drawdown we saw back then was actually as high from a month-to-month basis, we don't measure it daily, of 17%. That's how far the portfolio fell. So the 6.6 is obviously quite a bit smaller than the loss we had then. But what was interesting back then is the 17% loss, you may recall this from a meeting early in 2020, was actually below the benchmark. And we were very, very disappointed with that. We attributed it to insanity in the markets, but nevertheless, that's what happened. And the S&P was down 19.6% over that period of time. So just very interesting that we are capturing a lot less of the volatility this time. This is a much more, we would argue, normal sell-off. And that is, for us at least, maybe for you, I hope, a little comforting to know that the strategies we rely on are working quite well here. So we go to the next slide. When you have performance numbers that beat benchmarks, you would expect that you would also be doing well against your peers, and that's what this shows you. So this is the performance of the portfolio compared to what we call the investment endowment foundation index. And this is about 900 to 1,000 endowments and foundations who report their returns on a quarterly basis. And if you look at the green bar in the middle of the page, you can see the community foundation's returns. So these are the numbers that I'm sorry, I'm getting a little bit of an internet message, of course. These are the numbers that are correlate with those bars you saw on the very first page. And so quite good, as you can see. The median return for Investmetrics is basically the middle of the distribution. So think about it this way, the 12.6% for 2021, half of the participants had higher returns and half had lower returns. And that's what a median is statistically. If you look at the Investmetrics quartile at the top, So the first is what is a boring chart. We love that. This is the kind of boring we like, which is its top quartile for each period of time, which means top 25%. Just so you know what the rest of the numbers are, there would be something called second quartile, which would be above the median, but below the top 25%. Third quartile would be below the median, but not the bottom. And then fourth is the very bottom. We have had, if you go back and look at prior presentations, we have had fourth and third quartile numbers for 1 year and 3 years. And that is, we don't love that, obviously, no to you. But again, back to going to where the puck is. We want to be in the place where returns are coming from, not from where they were. But this is not one of those times. The portfolio's diversification and its manager selection and its private equity have been extremely powerful here. And so you'll see its first quartile for every single period of time. We've asterisked the 7 and 20-year numbers, and that's top decile. So when you go back to the slide, don't go back, but if you went back to the slide before, I know you all have the slides, and look at the premium to the CPI plus spending, to get that required a top 10% return by endowments across the universe of endowments and foundations. Thank you. So that just didn't happen. You had to be basically above 90% plus of your peers to get there. So it was something that would require great diligence and thoughtfulness and a little bit of luck to get there again. But we're hoping that we're pretty confident that we've got the right strategy and the right approach. So now if we can jump ahead. So one of the things that I know many of you probably find frustrating, and today will probably be no exception, is that we're really, really long-term people. So we do pay attention to what's happening in the world. Obviously, you have to as a reasonable person, but it doesn't drive us. We didn't change the portfolio strategy with concern about what Russia would do. We're not going to change it for a variety of other events, some predictable, some not so predictable. We think very long-term. Now, what we do think about, though, is how should the portfolio be positioned in terms of its reactions to such things? And we'll talk about that a little bit more in a minute. So first thing, 3 basic rules that we follow here. Rule 1, think long-term. That's what a strategic asset allocation is all about. Rule 2, no market timing or changing of strategy. I'm actually doing a manager due diligence trip, so I'm nervous about my internet this morning. I'm at the West Coast, but I was sitting in a Starbucks doing a call yesterday, and the guy next to me was essentially having a really hard time deciding what to do with his stock investments because of what's going on in the Ukraine and other things. And it struck me as, wow, that's a really hard thing to get right. And so we don't try. And there's charts which we did not include, but maybe next time I'll need to again, which show how much your returns drop if you miss the best days in the market. And we don't personally believe that we have the ability, nor do we think anyone else does, to step out of the way when markets drop and then jump right back in when they're going back up. That's just not a strategy we're going to ever pursue. It's incredibly risky. People think it's not risky, but it actually is. And then last but not least, and just speaking for myself, not for the committee or the foundation, but the ignorant man diversifies. So if you're not sure about the short term and you're taking a very long view, you want to be diversified, which gets to our next slide. So this is what a diversified strategic mix looks like. In the era of quantitative easing, which we will come back to in a moment, as I can guarantee you, we're at a time where we're not getting paid to own bonds, and so we don't want to own a lot of bonds. So that's why you see there's 15% allocated to fixed income today, which is a very low number. I personally would sleep very nicely at night if we had more, but we're not going to do more when interest rates are as low as they are. So rising interest rates, while painful for bondholders and potentially for the stock market in some level, is really, really a good thing. And so we would like to see that continue. I'll talk about that in a minute too. So you can see that the portfolio is very oriented to long-term investments. And you can see the 62% in total equities. As a reminder, opportunistic and special situations, these are investments that we make in very concentrated, specialized managers. They might focus on Japanese activists, for example, and other strategies like that. And they've been a big contributor over time to some of the return premiums you've seen before. We still have a small hedge fund exposure, as you can tell. The private assets has been extremely successful of late. As you'll know, we'll talk about the hedge funds in a minute too, and then the mission investments, which Christian referred to a minute ago, have been a great part of the portfolio as well. So this mix, as a reminder for everyone, is reviewed by the committee annually. It is not changed annually, and it moves. It's like watching grass grow to see this thing change. Now, what would cause it to change more quickly is if interest rates tomorrow were 3% higher than they are today, if the stock market fell 50% from here, those would cause us to move more quickly because it changes the opportunity set on a go-forward basis again. And remember, for people, a lot of people do it the other way. Everything is backwards for us. So if prices rise, we want less of that. If prices fall, we want more of that. And because the underlying assumption is that what we're buying has quality and it's worth more than the current price. So when a price is something, so if you can buy a loaf of bread that's usually paid $2 for, and you can pay $1 for it, that's great, right? And if for some reason the baker sells it to you for 50 cents the next day and it's the same loaf of bread, then you'll take even more of that bread at that point. So that's how we should think about stocks. It's not how people do. People hate price declines because they own the asset that's not dropping in price, but you really want more of a good thing, not less. So we go to the next slide. Excuse me. I mentioned the premiums to the benchmarks. I'm going to touch on this very quickly because there's so many different things to talk about today, but just to leave you with a quick thing. The point of this exercise at Crucial and with the Community Foundation and the investment committee is that we're looking for really, really special investors. So these are not the run-of-the-mill asset management firms that are used in the portfolio. These are really amazing firms in our opinion. We don't always get it right, to be clear, but we find a lot of interesting people. This is a very entrepreneurial and dynamic industry. There are people starting new businesses every day in this industry. And so there's a lot of people to find that we can look at. And we reject 90 to 95% of the ideas out there because it is hard to beat the indexes. And if I didn't have at Crucial, we have a team of 17 people whose job it is to scour the world for these managers. If we didn't have that, I'd own index funds too. But we have an edge that the foundation has done, as you can see earlier, done a nice job capitalizing on. So I'm going to jump to the next slide. Part of the edge, though, which is worth spending a moment on, is we believe in something. This is a concept I think you've heard me speak of before. It's called variant perception. And what a variant perception means in English is that I see something different than you do. I can look at the same set of financial circumstances for a company. I can talk to the same management team. I can think about an industry the same exact way, but I'm a different person and I see things differently. I pick up on something that maybe you don't. You pick up on something that I don't. And when you have a variant perception, i.e. an idea, a view, a conclusion that's different than those of other people, what you can do is you can look at the capital market price and maybe find a gap. And that's what variant perception means. Now, there are a lot of ways to pursue variant perception. One way in our early days was geography. So employing managers on continents around the world is really important. People sitting in different places see the world differently. Second way to pursue variant perception is through age. So we actually, the Community Foundation hired a very young done only once or twice. It's a hard thing to do. Very young, I mean, late 20s portfolio manager a bunch of years ago, has been enormously successful. And he sees things a little differently than somebody who's a little more mature, like me, for example. And so that's another aspect. But then you get to the third, which might be the most powerful, which is gender and ethnicity. Women and people of ethnically diverse people see things differently than others. Their life experiences are different. Their perceptions are different. And when we can put together, as we've done in this portfolio, a group of investors who are all exceptionally capable investors, but all see the world differently, in part because of who they are as people, that is a beautiful, beautiful thing. And that is what we're doing. It's a wonderful example of how diversity works and how powerful it is. And it's funny to me that the investment management industry is so slow to adopt this because it's so obviously the right thing to do, not just because it's the right thing to do for a fair and just society, but the right thing to do for your portfolios. And frankly, we would argue that 10 years from now, it's going to be rough to beat that CPI plus spending again. And if you're not using diversity, you've made your odds even lower. So we go to the next slide. This is just a quick snapshot of the diversity in the portfolio. The foundation's definition at the bottom. What you can see is the committee tracks this very carefully. It's a great example of having goals to make sure that we're continuing to pursue the concept of diversity and making sure it's a part of our thought process at all time. But it's also a great example of a goal that we will continue to try to lap and will easily lap because we are finding so many interesting people to invest. And this is just the managers in the US who are ethnically diverse and women. This does not include managers outside the US as well. So we go to the next page. Let's get to the problem. So I wanted to talk today about the slow-moving philanthropic crash going on. That's why I spent so much time earlier. I'm going to weave in what's happening in the world as we speak. That's the problem with giving presentations during a real time. But here's the things that we think that philanthropic investors should be worried about. The first one is that inflation is rising. And by the way, we would love to believe, as others would, that this will peter out and go back down to lower levels. I don't think that's a prudent way to think about this. I think it's more likely that's not the case. We have very low interest rates in the United States today still. I'll show you a chart about that in a minute, and very expensive equity indexes. So this combination is quite noxious. I think that's a good word. And it creates a really huge headwind for investors. It actually it has nothing to do with the Ukraine, it has nothing to do with speculation in the markets. It has everything to do with the long-term problems that exist when you start in a place of such great optimism in the markets. It's a terrifying, terrifying thing if you think about it. It's what keeps me up at night. And then the last thing, two last things, is a lot of people don't talk about price. They want to say, well, this is a great company, and that's where their analysis ends. The problem is that's not what investing is. Investing is the difference between how good a business is and what you're paying for that business. Sometimes you can buy really, really terrible businesses at really, really low prices, and they're great investments. Sometimes you can buy amazing businesses at very, very high prices, and they're terrible investments. People have a very hard time with that. And the main reason they do is because establishing the valuation of a business is not easy. It's an art, it's a science, it takes a ton of work. You don't watch it on TV. And you can't tweet about it. It has to actually have a lot of work and depth. And that's what we pay our managers to do, is that kind of work. Market speculation was something we've talked about a couple of times at these meetings before. And I would point out that it is unfortunately coming out. And I say unfortunately because we knew this would have to happen. And there's been gigantic losses for people, particularly in some of the innovation funds and the small cap tech and healthcare names. And if, for those of you who are curious about what we think, obviously we're not thematic investors because it usually involves ignoring price. But I will tell you that while I wouldn't touch most of the funds out there, the ETFs in this area, I would tell you that some of the things they own have gotten very cheap. And so there's the worst days might be behind investors in those types of funds. So we go to the next page. Let's switch to can't come up with my words this morning. The lack of reality, that's probably the best thing to do in the bond market today. So this is not today, by the way. We went back in time to the late 70s, early 80s, and wanted to show you something, which is how the bond market reacts to inflation. So the gray line that you're looking at here is the inflation rate on a rolling 12-month period from 1970 to the mid 80s. The blue bar is the yield on the 10-year treasury through this period of time. And so you'll see, if you look at most of the graph, inflation rises, inflation falls, inflation rises. The 10-year treasury sort of hangs around, basically doing a pretty good job predicting the fact that inflation was steadily rising, but it doesn't move with every gyration of inflation. But now look at the right side of the graph. This is what's important and what people today need to think about. So inflation plunged, as you can see. Those were the Volcker years, and inflation was actually basically dead. We haven't really had a serious problem until now, maybe. And so this was a big thing. But like we always are, we don't know that. No one sitting in 1984 knew this. So if you did, you were really, really smart or really, really lucky. So nobody knew these things. And so ultimately, what you end up having happen is the bond market didn't react right away, as you can see. So the blue line stayed very, very high. And why did that happen? And it didn't happen because people were crazy. It happened because they assumed that gray line was going to do what it always did before, which is come right back up. And therein lied the problem and also the opportunity in this case, because inflation did stay low. That blue line over the next 25 years or so, as we know, got much, much lower. I think it's actually 35 years. And so basically, trying to do math in my head too quickly, sorry. Came lower. And so that gigantic collapse in the blue line, which is where we're at today, and I'm not going to show you a graph, but I just want to point this out, created a huge return. So today we have the opposite. I don't have a graph, but if you looked at this chart today, what you'd see is inflation low, 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 then rising, and the bond market not really reacting that much. So today we have what's called a negative real yield in the United States, which means that if inflation is around 7%, and the 10-year treasury is around 2%, you just do the math. It's subtract. So 2 minus 7 is negative 5. So investors are essentially accepting a negative 5% inflation-adjusted yield. That's not sustainable. One of two things has to happen. Inflation has to come way, way back down again. That will be easier for the bond market, or the bond market has to adjust. And that's probably what's going to happen here. So it's going to be a very difficult time for fixed income investors, barring the only scenarios where that doesn't happen is days like today, where you have a huge geopolitical conflict, or if COVID proves to be something that is not as much in the rearview mirror as we'd all like it to be. So go to the next slide. So just one more second about the bond market. And the point of this graph, and I'll be really quick, is the world is changing. The markets are adjusting. It's taking time. It's slow. And this is the most dramatic way to see it. So as a reminder, we talked about this years ago, and I remember fumbling the explanation of it because it's hard to explain. I mentioned a minute ago negative real yields. So 2% treasuries minus 7%, inflation -5. That's a very important calculation. But there's another thing that's happened out there that you're all aware of, I know, which is we've actually had negative yields, which means forget the treasury at 2. German yields, Japanese yields, et cetera, were actually below 0. And the only reason that actually isn't as illogical as it sounds, because yields can be below 0 if there's deflation, i.e. falling prices. It's not irrational. But when you think about it, it's a little nuts, which is that a negative interest rate means that if I want to lend, since Claudia and I were sharing a profile this morning, if I want to lend Claudia money, I have to pay her to use my money. That's what a negative yield looks like. And it's a kind of absurd transaction, especially for me, good one for her. But the reality is that we don't want to do that. And so the bottom line is a little crazy. Yet nevertheless, when you look at this graph, through even before COVID and into COVID, we had $17-18 trillion of negative yielding debt in the world. Excuse me, and it wasn't in the US. Look at the right though. That plunging you see there is the market starting to adjust to, one, COVID hopefully being less of a constant economic issue, and two, the reality that interest rates are just too low. And so the adjustments started to happen. This is a very important change in market behavior, and I think it means a lot about the future. So if we turn to the next slide, the process of, I'm just very quickly here, the other thing which people are starting to come around to is that in the world, the reactions to inflation are going to be different. The actual levels of inflation are going to be different. So the US and Europe are kind of in the same boat together. We'll probably have a very similar experience. Emerging markets are different. They've been dealing with inflation forever. Asia is very different. Japan doesn't have inflation. That's happening in Japan would be some inflation. And so this is one of the things where the diversification of the portfolio, which I showed you earlier with the non-US exposures, et cetera, is enormously helpful. And what we're showing you here, and I don't want to be too short term, is, and I'm not going to torture you all with the technicalities here, but what you can see here is that the German, what we call spread, which is the difference between the 2-year yield on a German bond and the 10-year yield, is essentially been rising quick while the opposites happen in the United States. And that's because of just the differences in monetary policy, the differences in the way markets are pricing securities. But my point is that this difference you see here is not significant in and of itself, but it is significant in the sense that it creates complexity in the markets and reflects what we keep referring to our firm as regime change, which is that the things that we've all kind of believed because of the last 5 to 10 years are changing. And that's what makes it very hard for investors who own what has been working, which leads to the next slide. And I think the mother of what has been working is right here. And I'll spend a minute on this if you don't mind. So this is the S&P 500 SHilla ratio. So SHilla ratios are something that people really don't find that interesting, but we do. And the reason we do is because they're great long-term predictors of return. They are terrible short-term predictors of return, by the way. They have absolutely no significance whatsoever from a short-term perspective. So what Bob Shiller did, so he was a professor at Yale. He came up with this idea that the problem with price-earning ratios in the market, which is a way to, what am I paying for $1 of earnings? The problem with those is that you end up with the cyclicality of the economy as being a problem in terms of, like, in a recession, earnings drop a lot. So price earnings ratios look very high, but if the market and the economy recovers, they're actually very low, and vice versa. In a booming time, PE ratios look low, but they're actually quite high. So what he wanted to do was, let's squeeze out that cyclicality in the numbers. And the way to do that is to do something just very simple that everyone can get their arms around, which is just take a 10-year average of the inflation rate and use that after you adjust a 10-year average of earnings adjusted for inflation. So that's the E. So it moves a lot more slowly as because it's a 10-year average than the current earnings ratios or earnings numbers of companies or the index. So now when you look at this chart, if you put the SHilla ratio in perspective historically, what you need to do is you start in the first set of columns where you see that those ranges we've listed there. And so the ranges are different buckets of history. This goes back to, I think we got data back to the 1800s in this number. Bob puts on his website. We didn't create it ourselves. Now look at the second column, which is how many times in history using monthly data has the SHilla ratio been in each of these buckets. So we highlighted in yellow that second to top line because that's where the SHilla ratio was actually at the end of last year. It just this morning, because the markets are down, dropped just barely into the category below, just to be clear. So even after an almost 12% drop in the S&P, actually 13 now, the SHilla ratio is still extremely high. And now look to the right. So first problem, if you're an investor, you need to think about, well, if there are something in the order of 1,500 observations here of SHilla ratios, only 34 times in history has the ratio been as high as it is today. So that should be disconcerting to us. We don't like stuff like that. That's really, really bad. And the reason it's really bad is it's what I said earlier, that loaf of bread is much more valuable to you if it's cheaper and not more expensive. And so look at the right side of this column now again. So what we did here is we said, let's take each of these buckets of SHilla ratios and measure the return from 10 years forward. So if the SHilla ratio in 2007, I don't know what it was, let's say it was 36. What was the investment return for the S&P from 2008 to 2017? And that's what gets into these numbers on the right. So look at the medians. It actually makes perfect sense. There's a concept in statistics called correlation without causation, which means that even though you find a relationship, it doesn't actually need to exist. There's no reason for it to exist. This is not that. This makes perfect sense. So at the bottom, when SHilla ratios are low, the future returns are much higher. You can see 15% per year, and this includes dividends, was the return when the SHilla ratio was in that bottom bucket. And the numbers generally go down over time because higher prices are bad news for forward returns. So look at the yellow bar again. 2.6% was the median return. So that's what the expected return would be if you just want to use history as a guide today. Look at the other two columns. The worst case scenario was an actual negative rate of return. We're talking about negative yields before. That's nothing. Negative rates of return on your stock portfolio for a decade is a disaster. And then 4.7%, if you want to be optimistic, is the best that ever happened. Now, we did just dip into that next level down. So the median goes up. The worst case actually gets worse somehow, and the best case gets better. So that's good news. And again, that's why sometimes when markets start to perform the way they are now, you lick your wounds, you feel bad about the losses. Nobody likes it. And we all have these darn phones and we're always looking at it, but everything's worth all the time. It's a really unhealthy emotional process, if you ask me. But the fact is that falling prices are good news for us on a long-term basis. You just have to be very patient sometimes. So the next slide. Here's why, and my wife keeps telling me stop smiling during falling markets. And it's not because, by the way, she's right. There's no joy in people losing money and suffering. And some people, unfortunately, realize those losses by either making mistakes or even making the other mistake, which is selling because they're nervous. Investing is not a good thing when you're nervous. Obviously, it's a bad combination. So why do we smile? And we smile, one, because diversification worked a lot better. I do find it frustrating, I will admit, to spend all the time we spend and then look back and say, well, we just had to buy Apple. We would have been better off. That's a frustrating answer for us. So we're not rooting against Apple, of course, but at the same time, the idea that the diversification actually has value, which we strongly believe it does, it does have to eventually prove itself. So these times help us with that. What you're looking at here briefly, this graph shows you the spread in valuations in the market. So it's very important. And the way you think about it is the green line is the price earnings ratio. Don't spend much time on that. But look at the gray bars that kind of surround it and look how wide they've gotten. And when the bars get that wide, it's really important because what that does is it gives us a much bigger opportunity set to invest across. And we really, really love that. It gives us a lot more on the cheap side, and that's below the bar, and even the expensive stuff. Some of that actually is cheap in disguise. So we go to the next slide. Give me a big opportunity set, and then also give me more choices as well. So this graph goes back to 1990 and looks at the number of publicly traded companies. And it's very interesting because you can see they peaked over 8,800, and that was the top of the TMT bubble in the late 90s. That plunging you see to the right was two things. One, it was public companies that should not have been public companies going out of business. So that was the pets.com era. And a lot of companies they just went bankrupt. And that was really sad for a lot of people. And it was also a regulation coming in, particularly because some of the abuses that occurred from an accounting and governance perspective. So it made it less and less attractive to be a public company. And what you see here is we're not back to that peak, but the number of public companies is up to 6,200. Which in part reflects the boom going on in venture capital today. So we are making the same mistake again. There are companies coming public that probably shouldn't, but nevertheless, so let's hope everyone who's picking those companies knows what they're doing. That's one thing happening. The other thing happening though, is that it's gotten, the capital markets have more choices. We have a very dynamic economy. There's another way to raise capital. So it can have some very good news. From our perspective, it has a lot of good news because again, we like having more choices. slide before that people are paying very different prices for things, one versus the other, historically speaking. And then today we have more choices. So this is really exciting for us. And none of it has to do with Ukraine or anything else. It just has to do with the opportunity set, which is quite remarkable. Go to the next slide. So the game plan is simple here. We're going to overcome our headwinds with diversification. One of the things that people may not realize right now is the places we're actually making money this year are very interesting. We're making money in non-US value stocks. We're making money in emerging markets. And diversification is truly working. That does have me excited. Second thing is price valuation are really important, and contrarian thinking is really important. It's hard to be a contrarian, because there's nothing worse than owning something that everybody else thinks is stupid and having it not do well at the same time. It's a terrible feeling, but it really does work, especially in a diversified portfolio. And as I mentioned earlier, we have access to amazing investors around the world, and we spend a lot of time talking to them. And this is a really, really exciting time. There's so many opportunities, and there's a lot of risks too, and that's where the opportunities come from. But you pick the right companies with the right structures and the right prices, things turn out pretty well for you if you're willing to wait. And that's the foundation strategy in a nutshell. So Joseph, I think I'm going to stop there. I know we've probably a couple of the slides, but I want to be respectful of the timing given our scheduling here today.
Great. Well, thanks for all of that information, Mike, and your perspective, really valuable. So I think, we've gotten a couple of questions both prior to today and this morning regarding what's unfolding in Europe, specifically in Ukraine and Russia, the sanctions that have already been announced, including those that will be announced today, it sounds like. A lot of those related to oil and energy. Curious to get your take on, how that may impact investors, especially given the success that we've seen in international markets. I think we'll kind of just take that one question, since a lot of the questions sort of wrap up into that one, and then we'll head towards a close here.
Perfect, Joseph. So let me state, there's a lot of different things in there to think about. I'll give you a very brief version. If it's not just you want me to go further, I'm happy to, of course. So first, let me give everyone some comfort here. The foundation actually has, I believe, zero investments in Russia. And there's all kinds of reasons that we can talk about, which ties to the second issue, actually, which is that risks like Russia, Ukraine, risks like rising inflation, risks like China invading Taiwan. We can go to a whole long list of things that we could talk about all day that are concerning. The way you address those risks as an investor is the company underwriting itself. So we would expect everyone who manages money for the foundation to have been very thoughtful about, well, does this company do business in Russia? What would happen if this company could no longer do business in Russia? What am I paying for at the price? And what risks am I taking if I invest in this business? So that kind of analysis, which is kind of at the very bottom level here, is incredibly important as we assess risks. The oil price issue is a fascinating one, as is the sanctions issue. The reality is that I'm not sure how much teeth the sanctions are actually going to have here. And the reason is that, first of all, we've already done the things that you easily do, cut off their access to bond markets around the world, but they have huge reserves. They can afford to stay in this war for a long time without having access to bond markets. They shut off a pipeline that wasn't piping anything anyway, so that wasn't particularly important. The problem that Western leaders are facing, Europe and our own president, is that a lot of us are already not happy about rising gas prices and inflation. So really cutting Russians off would make those prices go even higher. And that's a political nightmare if you're the president of the United States or any of the heads of the European countries as well. So how much they're going to be willing to do is going to be tough because at some point people are already upset about gas prices. And that's a worry in terms of whether we have any ability to stop what Russia is doing, or people are just going to unfortunately have to let it happen, which is just terrifying. Obviously, that's what Putin's is betting on, is that no one's going to really step in and do anything important. And I'm not sure that they're going to either. He might be right about that. So there's a lot going on there. Key thing I would just remind you is markets have a way of overreacting to things. So oil prices will probably go to levels that are probably are sustainably too unsustainable. Stock prices might drop to unsustainable levels. All kinds of things happen. And that's where the discipline of saying that loaf of bread is worth $1 is really important. And that's what we pay all these people to do in your portfolio. And you pay us to make sure they're doing it and doing it the best that we think they can, and diversifying those folks as well.
Great. Well, thank you again for your time this morning and your presentation. We're always grateful for your partnership and that of everyone who was able to join us on the call this morning as we work together to inspire philanthropy, strengthen communities, and really work towards building a Milwaukee for all. So to close us out this morning, it's my pleasure to transition to Ken Robertson, who's our Chief Executive Vice President, Chief Operating Officer, and Chief Financial Officer. So Ken, would you please take it away?
Thank you, Joseph. And thanks to Mike and Crucial for being trusted partners who consistently deliver reliable and relevant information. Information is as important as ever during these very unpredictable times. We're in it for the long term. Our strategies ensure long-term growth so our community will benefit for generations to come. Speaking of long-term investments, we're getting closer and closer to seeing physical progress through our Thrive On collaboration. What is Thrive On? It's a place-based investment with our terrific partners, Medical College of Wisconsin and Royal Capital. We're redeveloping the former Gimbel's Schuster's department store, where we'll be moving our headquarters there. What really makes Thrive On special is that it's community-centered. Community residents are not just advisors, they're leaders. Their leadership is informing our approaches, focusing our investments, informing our programming, and they are telling us how they want to use the space. The first floor of the Thrive On King will be focused on some amazing things. There'll be community use, there'll be cafes, there'll be neighborhood halls, community rooms, places for makerspace, conference rooms, an area really to explore art, culture, and history. We really think this is going to be a thriving neighborhood and a thriving building at the center of it. There'll be lots more detail to share as we continue to refine the details of this project, and we'll be excited to bring those details to you. There'll also be opportunities for you to get involved and partner with us. So talk to your philanthropic advisor and let them know that you want to support this project and you want to collaborate with us. As we close, I just want to take a personal moment to thank you and to thank the staff of our foundation. We've had an amazing year in 2021. Financially, we're stronger than we've ever been, but our greatest asset is our people. And you can really be proud of the tremendous work that your staff is doing. So I'll close with, again, thanking you for joining us today. We hope to see you next quarter, and I hope you have a fantastic week.